All right. Hello, good afternoon, everyone. My name is Tanguy Piret. I work for JP Morgan. I'm actually the global chair of JP Morgan for the investment banking. And you have Rob. Rob works in our team in London, and he only does one job, is raising equity for startups, high growth company. This is his only job. And we love to come to the Odoo experience. I think it's my fifth time or fourth time, I can't remember now. And just to give you a dedication, I'm sure you saw Fabien in the news saying he raised money at 7 billion. Last year we were the boys working on that transaction, so we helped Fabien to recycle €500 million of capital for him. And that's a bit what we want to discuss today, guys. Please shoot questions. We have a presentation. We're going to go through some of the slides, not all the slides. There is a lot of data. We are investment bankers, so we like data. We are data-driven people. But what I wanted to cover today specifically is, one, the state of the market. And people are going to say, oh, why you spend time on state of the market when you want to raise equity? But I think it's super important in our industry because people tend to try to raise equity against the wind or against a backdrop. So it's super important. Where are we today? Do investors want to work or not work, or they want to go on the beach and just do nothing? So I think for you guys as well, when you try to raise equity, this is the first thing you really need to think. Am I in a cycle where I can raise the money, or am I in a cycle where you don't want to raise the money, and whatever you talk, you're going to have hundreds of meetings, none of the investors are going to put money to work because either they lose money, because they don't have the money, or because they are over-invested. So all of this you can see, and so we're going to spend time on that. Then we're going to spend time on the private market, which is more the market I guess you focus on. And this is Rob. Rob is going to tell you where the private market is, what's the recipe to raise money in the private market, and what are the structures as well. Because the world has moved a lot from simple equity raise to very complex instrument you need to understand. You as entrepreneur, most of you need to understand what you're subscribed for. So I think that I'm going to start very quickly because it's a short presentation on the market and where we are. So the first thing every investor will look is, today, have I made money? And the good news for everybody here, all of the investors from this year, they make lots of money. So we have a lot of guys who are willing to work, willing to do money to work, because so far they have a good P&L, they have a good return, so they are making profit. And when they make profit, they want to make more profit. So you have the first state of the market, and you see the second point at the bottom is the valuation on the public market, not the private market, is all-time high. We've never really seen this market. All the indices are all-time high. So there's also the question, am I too late in the cycle? Do I want to invest still in that volatile market? Am I taking too much risk? Am I going the one buying at the top and then the crash? 2021, we all remember, you were doing private. We were raising private capital like no tomorrow at valuation, which we've never seen. We were not even printing book. We were just showing an ID, capital was flowing, and then the cycle came. So I think investors, in the back of their mind, they are in the cycle, say, is that the right wave to catch? The second element for you is, of course, the macro indicators. Are we in a recession, not in a recession? I think it's quite important for you to understand. So the vision is like it's okay-ish, and it's gonna be surprising. Geopolitics aside, crazy Trump on one side, everybody is kind of okay. Economy is okay-ish, inflation is coming down, which is good. Rates are coming down, which is good for equity investors. So there's a bit of a win in the sale, as we say, which means that the guys are saying, yeah, it's kind of okay. It's not great, but it's kind of okay. And then you see the sectors. It's super important as well. Have I made money in sectors? And we have clients, look at the bottom of the slide. Yeah, can we do biotech? And I'm sure you look at Belgian press, lots of biotech not finding the money, very difficult environment. The reality is the guys, they lost money in healthcare. So a lot of the VC who invested in biotech for now, they're just like, nah, I've lost money this year. Am I going to put more money to work? If you look at finance, industrials, and in the US, tech, media, they all make tons of money. That's why a lot of people invest in tech. Good for you guys. Software, AI, everything which does tech. A lot of investors are pouring money into the sectors for now, and that's a big difference you see. I think that I'll skip that slide. It's the same. It's macro. I think this is as well, do we believe there's growth or pricing? And you can see it's a mix between the growth and pricing, so which is okay still for investors. They believe there's still growth in the system. Then that's important for you, and I'll let also Rob comment this. It's the famous rule of 40. I'm sure you heard this. If you have the rule of 40, which is if you add your growth, you add your margin, am I in the 40 club or not in the 40 club? And you can see that every time you're above this rule, you raise money at higher valuation. And it's a mix now between growth and margin. Before it was only growth, so you had guy growing at 40, 50%, and Odoo is one of them, but they have the margin on top. So the rule of 40 there and the rule of 60. And you can see that the gap of valuation between growth and profit is still huge. So you can see all of this element that when you address these investors, this is stupid maybe, but this is how they're going to screen you with computers and AI. Am I in that rule of 40 plus? If you're not, it's going to be very tough. Then of course the key macro team, of course the economy is somewhat shocked by the tariff, but it's continued to ponder through, to go through the motion. Growth and earnings, there was a huge expectation that H1 would be bad. And actually H1 has been okay-ish. So all the markets say, well, the results are better, we make money, we continue to rise. That's why September, and we'll talk about it, in Europe it's not the case. In the US, it's the highest season in IPO we've had since 2021. The number of IPOs, so equity raise on file with the SEC and NASDAQ, all of the regulators, is the highest number we had. So we have a huge season of people going public and trying to grab the window. Interest rates are coming down, and we discussed about it. It's important for you guys because it means that there's going to be more money flowing into equities and new VCs. So, as I said, that's the public market. Equity capital markets, as I told you, valuation are high, volatility is low after now the Liberation Day being over. Equity markets are up, interests are down, which means IPO season. It's always the same. This is going to close, so we're going to have a season, a month or two, then it's going to close, and you're going to see that again and again. Then here, it's to show you the phenomenon. People say, oh, there's no IPO, there's no IPO. Look at the chart. This is year to date. Last year, we raised, for the full year, 6 billion only. We have already raised 11 billion. And it's only, and the season has not really started. So you can see the amount of capital being raised in the public market. So the sentiment in the press, especially in Europe, there are no IPOs, or Euronext, yeah, maybe in Belgium, but the rest of the world, there is a lot of money being worked. I think that's quite important to see for you as well. And long only, if you see long only that the guys who want to invest for long, they are here to stay, they want to invest. I think this one is the performance. They did the IPO, they made money, so they want to do more deal. That's a good for you as well. So all the performance of all the IPO we've done this year has been positive, which means that the investors are very happy, though they want to do more. Because we had a wave of IPO where it was the other way around. They went into IPOs, the money crashed the 2 days after that. It was a disaster. They didn't want to subscribe to IPO. I skipped that, it's retail. This is like the amount of money and guys who are on fire. You can see, this is a series of logos. These are the guys we track and who are going into money and IPO. So M&A as well has been very active on our side. So again, very important. Why? You say, oh, why M&A? I raise money. Because every investors, when they go to their IC, the first question the IC asks, and I go to IC every week, what's my exit? How am I going to exit your companies? And now what we do as JP Morgan, we actually write the exit memo. The entry memo is easy. Oh, it's a great company and so on, but 5 years down the road, 7 years down the road, is this company is going to be great? It's going to be, but how can I get out of it? And that's something you need to think as an entrepreneur. What will you be in 5 years? How big will you be? How can I exit? Do I do another VC round? Do I go public? Do I go private with an M&A deal? Is there strategic buyers who are going? I can tell you we are doing a private placement now, very big. The only question the investors ask is say, we love the story, it's big. They are not going to be a private equity or VC behind. So we're going to be stuck with it, so we don't want to subscribe. Despite they love the story. And I think Odoo, when we did the placement, it was already 5 billion. You saw early in the morning with 7 now. Investors were like that. Look, I'm putting money, do it at 5 billion. The next round is going to be in 5 years, 10 billion. That's what Fabien said in 2027. 10 billion, who can write check like that? And I think it's for each stage, you're facing investors who are getting to their limits. So if you're Series A, they put 5 million, but if you need to put 50 million, these guys can't follow. So you need to reinvent the story. So I'll skip this is M&A. I want to spend time with Rob on the private capital market, and I'll step in as well.
Thanks, Tanguy. And I think, again, just to zoom in on why the public markets is important in looking at the private markets, that is how all investors are going to look at this. Everyone is looking at how the public markets are trading. To Tonguy's point, where is my exit? Should I be pricing growth more than I should be pricing profitability? How is this business going to fare at exit? What does that mean? And how do I therefore underwrite the path from today until then? And so I think, although some of what Tanguy was just talking about can seem quite far away for a lot of the people in the room perhaps, it's extremely important because that's ultimately what the LPs at the investors are talking about, that's what the investment committees are talking about, and that's the same data that they're looking at. And so when investment teams, the people that love the businesses and want to underwrite the check, are going to these committees, they're having the challenge from people at the LP and IC level who are looking at this and are saying public markets are doing X, this sector is doing Y. And so it's extremely important to have that context before we zoom in. So looking at the private market specifically, I think just in the top right chart, it's been performing well. Clearly there was an enormous gain in 21. I think off the back of that, we are now more healthy than where we were in 2019 and 2018 and before that, before sort of 2020 and 21 went crazy. And I think just some of the themes, I won't need to go through all of these. I'm sure some people in the room are aware of these, but there's enormous amounts of money out there waiting to invest. And it's how do you translate that powder into actual deals? And I think we'll come on to that in a few slides' time. Another main thing is international investors coming into Europe. Again, to take the Odoo example, Sequoia and Capital G led that round last year. These are two very West Coast US-centric investors who are looking to Europe to see the next generation of company because the US market is either too small, and I know that may sound ridiculous, but it's too crowded, or it's too competitive, and the prices just aren't there. And so actually, there's certainly a wave of US investors looking at Europe and saying, this company is a European champion, this company may well be a specific country champion, but there's a real theme there.
If I can intervene 1 second, which is I think important for you, if I was in your shoes as an entrepreneur, is you have to run a business. It takes 200% already of your energy. But I think the thing which I realized when I talk to new entrepreneurs and startups, they want to raise, there are three issues which they face. They don't have the time. Second, they don't spend the time early on when they don't need the money. So they only call us where, look, guys, I have a year of cash, I want to raise money, I want to go on the road, and say, how many investors did you talk to? And they say, oh, 1 or 2 friends. And I think that's thing which I think Odoo did exactly the opposite. They don't need the money, but they were always permanently talking to investors. So when we did the raise, we had a log of like 50 investors who knew the story, followed the story. And so when we did this, when we pushed on the button, it was a very short process because everybody was warmed up. It was a virtuous circle. And I think if I can give you an advice, because the problem with our markets, these investors, they're very span of attention. Stories they don't know, they don't want to take the risk. And because of this market volatility, the market shut and open at time you don't match your stars. So which means that sometimes you're going to say, I need the money, and we're going to tell you, you know what? We just can't. There's no market for you guys. I'm sorry. Whatever the story, these guys are not investing. So I think you really need to take the time and the energy in the quarter period. When you travel for whatever, try to, in your mind, say, I'm going to see 3 investors. I'm in I'm in Paris. I'm going to go and see the 3 tech Paris investors. Don't need the money, simple doc. Don't do big presentation, just to talk, a coffee, a chat, and build that Rolodex of investors as much as you can. As much as you can. And the third element is, don't raise when you can and none when you need. All the most successful companies we followed raised the money at the time. They didn't need the money, but they just grabbed the window, took the money, and moved on. And yes, it might not be you sit on cash, great. And frankly, you should really think about that, because that's something, we have companies like the biotech from the moment, the biotech wave, everybody wants to raise money in biotech. I can tell you all the VCs are sitting on negative loss. They have no money to deploy for now unless it's de-risked story. And we're going to talk about it, the de-risking of the story. Investors are pure investors in VC. When it gets large, they're really scared.
So moving on then, I think the other theme there that we didn't touch on, valuations are improving, and this chart, it's a bit complicated, but essentially we're saying valuations are climbing at across early stages and late stages. The percentage difference in rounds is also increasing, so that's a positive. But the frequency of liquidation preferences, and this is what Tongi was talking about earlier about structures that may not make sense for founders raising at the time, that is also, it's come down, but it's by no means gone. And so the frequency of liquidation preference more than one, which is what we would sort of describe as off market, one is normal. So the more investor friendly environment is very much still around for those stories. And so there's a lot of nuance in how that captures for your rounds. This one I think is an important one, and to Tongi's point, what happens when markets are good, it almost has a bizarre flip effect where, because of the interest from investors in companies and because of the resurgence of the public markets, everyone is trying to do deals. That also means, though, that investors are getting hit by many more pitch decks than they were a year ago. And so their attention span is short, and their bar for saying no to something is extremely low. They're just looking for a reason not to invest or not to spend time on it because they're getting hit left, right, and center. And so the left-hand side of the chart here, the key number to have in mind is the 57%, and that's just the largest at the later stage deal, so Series D. There's an 8x on average difference between the valuation of a top quartile company and a bottom quartile company. Now you would expect there to be a difference between the top quartile and bottom quartile by the virtue of the fact that they are top and bottom. But that 57% is saying that the difference in that valuation is 57% higher than it is normally. And so essentially there's an exaggerated focus on the companies that are in that top quartile, and investors are happy to pay that premium price for those companies, and the lower quartile companies are getting ignored and are not getting the valuation that they perhaps would have deserved maybe 12 months ago. And you can see this a little bit on the right hand side, and we've just zoomed in on Series C here, but this is saying that, again, the top quartile companies are demanding about 137% premium on their last round versus the median of 50%, and actually, it's flat for the lowest quartile. This, I don't want to spend too much time on, but again, the cost of capital is anything from, underwriting common equity or subordinated in the capital structure. As a founder, that is your shares 9 times out of 10, to something that is much more debt-like on this side of the chart. And that's clearly giving taking a lot of the risk away from an investor, but it comes at various costs to the founder and to the company. And there's all sorts in between, and I think, we have a number of conversations with startups day in, day out about what these things mean. Because in this environment, as an investor, if you're time short, quite often it's easier to throw in something that protects your downside without having to diligence every aspect of the business plan in order to be able to give a founder a more clean structure.
I think what is important on the slide before for you is normally when you have an investor say, put equity into the firm. And the problem when there's this huge gap of valuation between an entrepreneur and an investor, that's why this product has been created, to try to bridge the gap between somebody who believes his business is worth €1 billion and the investors say, you know what, I'll pay you 100. We've seen so many. So the technicity for you, try to be educated to all these variations. So when an investor throws you a term sheet, because that's the way it operates, they're going to throw you a term sheet, this is what I want, and so on. You can really quickly react and say, look, I like that, I don't like that, but at least you understand the risk and the benefits. So trying to get them to their technology, because that market is evolving like a speed of light. I think it's super important for you to get educated to you on that.
This maybe just hammers home that point, and that difference in valuations when there's more structures in, but I think we don't have to spend too much time on these. Again, a couple of the recent deals that we've done, Odoo obviously on the slide, we wanted to include this, and this is just saying that at the later stage particularly, there's a lot of secondary deals that are happening, and I think that is enormously positive for early stage fundraising, because that means that the investors that are in these early stage companies are getting liquidity that they're able to recycle into earlier stage businesses as well. So going back to the point on proving yourself to be worthy of an investor's time and ultimately money and being in that top quartile, what do people need to focus on? And I think this really is just going back to basics. What is my equity story? What is my right to win in the market that I've chosen to operate in? Why is my tech, my team, my track record, why does that set me up better than that company over there or that company over there? What really is my right to win, and therefore what is